Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy with all the monthly ETFs. Today we're diving into one of the most popular and most talked about income ETF families on the market, and that is NEOS. NEOS has grown incredibly fast because it's mastered one thing, generating high income using disciplined option overlay strategies while still working to maintain exposure into the underlying asset. In our video today, I'm going to walk you through every major NEOS ETF across equities, bonds, real estate, commodities, and even crypto. So you can understand how these funds actually work, how they generate income, and where they might fit in a retirement income strategy. Before I jump into that, I got to do a shout out to all of our Patreon, all of our YouTube subscribers, and all of our YouTube members. Welcome. If you're not part of the family, don't be afraid to hit that subscribe button, hit that bell notification. You don't want to miss a single video. And if you can help support the channel, YouTube memberships, the easiest way to do it, or join us over at Patreon. We'd love to have you. Let's get into today's video. As always, this video is for educational and entertainment purposes only. Past performance does not guarantee future results. I am not a financial advisor, so talk to a licensed professional or guidance specific to what your needs are. NEOS is one of the largest growing providers in the enhanced income space. What makes it unique is that they use option overlays in a way that aims to boost income without fully sacrificing the NAV stability. Their philosophy has really three pillars. The first pillar is their option overlay strategy, that they use call spreads on ETFs, futures. This lets them target income while still holding the underlying asset. Monthly income focus. Every single NEOS ETF potentially pays monthly and consistently is a major part of their design. And risk management. They aim for NAV protection through a spread structure rather than naked calls. And what are those benefits? Higher yield potential, more consistent payouts, and an attempt to improve risk-adjusted returns. That's why their assets under management has exploded. Now, before we start reviewing individual funds, it's important to understand the four key metrics used to evaluating any income ETF. First one is yield. This is the analyzed distribution rate. Higher is not always better. Sustainability is the key. Now, return of capital, ROC. This shows how much of the distribution is coming from genuine income versus capital returned. The lower the ROC generally indicates healthier and more sustainable income. Now, the expense ratio, the rates range from 0.38% to 0.98% in the NEOS family. Lower fees mean more of the yield stays in your pocket. And then assets under management. Bigger assets under management usually is signals of strong investor confidence and liquidity. So keep these four metrics in mind as we go through each and every one of the funds. They'll help you decide what matches your personal strategy. So the first fund is SPYI, is NEOS flagship fund. You've probably heard me talk about this one on the channel many a times. The yield numbers have a 12.16%. The return of capital is 0.56%, so extremely low. Assets under management over $6 billion. And the expense ratio is 0.68%. While SPYI is not your typical covered call ETF, it uses the S&P 500 futures plus call spreads, which helps reduce the NAV drag you see in traditional buy-right products. The pros of this thing is a strong asset under management, more NAV friendly, and the potential for consistent monthly income. Now the cons. The upside is truly capped. Income fluctuates with S&P volatility. Best for retirees who want the S&P based income vehicle with monthly payouts and less drag. Now, number 2, QQQI is a tech-focused version of SPYI. If you have success in one fund, why not repeat it? And that's what they've done here. This is one of the fastest growing ETFs of any provider. The key metrics are simple. Yield, 14.31%. Return of capital, 0.02. It's almost literally zero, but 0.02. Assets under management, 6.22 billion. The expense ratio, 0.68%. Now this one launched in January of 2024, so we're a little over, or almost 2 years into this. The big story here is the very low ROC, meaning that the income is mostly real, generating from option premiums rather than capital return. So the pros, huge assets under management, excellent NAV preservation, and low ROC. The cons, the volatility because it's a heavy tech, heavy fund. Income can drop if the volatility falls. This is great for income seekers who want QQQ exposure without the extreme NAV erosion. Now we move into number 3. And that is going to be IWMI, which is the Russell 2000 High-Income ETF. This fund moves us into what we call the small cap territory. The key metrics come into this: a yield of 14.63%, assets under management 366 million. This launched in June of 2024 and has that expense ratio of 0.68%. Now again, the ROC, 0.64%. So this is a real worker. Small caps bring higher volatility, but that means higher option premiums. So the pros is you have a higher potential income, strong diversification away from those mega cap tech stocks by holding into the bigger, smaller caps. Now the cons, the Russell 2000 is more volatile. So you're going to see the rate go up, down with many swings. The lower long-term track record. And it's ideal for investors who want aggressive income with small cap diversification. Our next fund is the NIHI, and that is the MSCI International High Income ETF. This is NEOS's international income play. When we look at this one here, you're going to see the key metrics again are 9.72% yield, continuing on into the NEOS high yield package. Their return of capital is 2.43%, so higher than the other funds that we've just looked at. Their expense ratio, 0.68%. Their assets under management, just a little over $20 million. Now, this fund is fairly new. This opened up in September of 2025, so we're really only about 3 months into it. Now, NIHI offers exposure to Europe, Asia, and Australia markets. The pros of this one is global diversification. So you're not just worrying about the U.S. market, you're looking outside the U.S. into a foreign area. Now, they offer that potential of the consistent income, doing that through their covered call spreads. Now, the cons, it's very new. So like I've always told you, you always got to give funds a little bit of breathing room, a little bit of time to find their space, and then learn what they're going to do. They have a very small assets under management, so it needs time to grow. International option markets aren't as effective. For best investors who want to diversify beyond the U.S., this gives you a U.S.-based company understanding markets, doing what they do best. Now we get into two hedge funds. This is the hedge fund strategies. These are really what we use as defensive versions of the QQQI and the SPYI. They both do call spreads and put spreads to reduce that downside risk. So we'll start with QQQH, and you look at the yield is 9.12%. Another return of capital, virtually 0%. The assets under management, $346 million, and an expense ratio of 0.68%. Now, the positives, basically, this is the oldest NEOS ETF that they have. This one launched in December of 2019. So we're almost to the point where it's having its 5th birthday. The other one is excellent NAV stability because of that protection of the downside. The cons, it's a lower yield due to the hedging. So you're putting it more to protecting the losses versus the growth. And it's less aggressive than the QQQI, but that's why we say it's a defensive move. Now we get into SPYH, and you can see the yield on this one again is lower, 7.88%. The ROC is a little bit higher, 0.57. Expense ratio is the same, 0.68, and they have about $15 million under assets under management. So it uses the S&P options plus protective puts. This one launched in April of this year, so that's why we're saying it's a newer fund. It uses, as I said, the S&P base for its holdings. It does the calls and protective puts. It's very defensive. It's a lower drawdowns during corrections. Again, cons, very new and small assets under management. The lower yield than SPYI. But this is perfect for investors who like monthly income but want a smoother ride. If you're not looking for the big dividends, this gives you that smoother, comfortable ride because it's giving you those puts for the downward protection and the calls for a little bit of that upside. Now we get into Bitcoin high income ETF, the BTCI. Now we get an eye-opening catching when we start with this one. Right off the bat, I know you're going to look at it and say, now we're talking high income with a yield. 28.36% yield. But look what happens when you go to the higher yield. You have a higher return of capital, 2.19%. Your expense ratios go up to 0.98%. And you have assets under management over $870 million. Now, this fund opened up basically a year ago, 10/16 of 2024. BTCI is a spot Bitcoin ETF that with call spreads on BTC futures, the Bitcoin futures. The crypto volatility is the massive option premiums. This is how it generates its income. It wants volatility in crypto. But the volatility is also equals higher risk. So don't let that always fool you. If you have higher volatility, you can generate higher income, but that comes with a lot higher risk. So the pros, very high income potential, strong assets under management, and more stable than owning raw Bitcoin directly. Now, the cons of this is going to give you the crypto risk, the high expense ratio, and the yield depends heavy on volatility of that crypto market. It's best for aggressive income seekers who can handle the crypto movement. I always like to put it as the roller coaster. You're going to have some great highs and you're going to have some great lows. If the volatility is there, that can generate some income. But you're not going to want to look at your daily portfolio because you're going to see it up, down, sideways numerous times. Now let's get into the real estate and commodities. And these two are really interesting pieces. The first one is IYRI, the real estate income. These funds provide diversification into real assets. One, it's going to be property. The yield, 11.01%, but the return of capital so far is one of our highest at 3.17%. Assets under management is $146 million. So this is great for basically people who wanting to be in the real estate business without owning the property. It gives you real estate index exposure. It gives you a covered call spreads. And it also gives you REIT, which is real estate investment trust, dividends, and option incomes. Now we switch over to the next one, IAUI, which is their gold income, high income ETF. Now this one here has your numbers of your yields of 12.96%, return of capital of 2.25%, and the assets under management of $186 million. Now this one uses gold futures and call spreads to generate its income. So you can see here that we put in there the long gold exposure to GLD and XAU, and then they use the call spreads for those gold futures and volatility premium extraction. They want gold to be rising. They want gold to be heavy volatility. Now the pros on these things is diversification and the inflation of hedge funding and the strong yields. Now the cons, both of them have ROC pressure. You can see that they're in that 2 and 3% category. The other one is the gold option pricing can be unpredictable. Real estate can be unpredictable. So is the real estate, you have the cons, the interest rate sensitivity. The higher the interest rate, the less housing will happen. The lower, the more housing happens. Higher ROC pressure, and it's a newer fund. Same thing in the gold side of it. Unpredictable option pricing, elevated ROC, and higher expense ratios. Now we're going to talk something that a lot of people talk about, and these are going to be bond income strategies. Now we have 4 of them on here. They pretty much all operate similar to each other. So these 4 funds form the bond side of NEOS. The HYBI, the credit bonds, the yield of 8.23%. The return of capital is extremely high at 5.91%. Now this is mostly aggressive of the bond group, because this is the credit income bond fund with enhanced overlay. It is the oldest NEOS income bond fund. The next one we look at is the aggregate bond income, BNDI, with a yield of 5.78%. Return of capital, 3.28%. And this is excellent for conservative investors. It's safer. It's the aggregate bond fund with the mild option overlay. They say it's very stable, good for conservative investors. Now the CSHI is the treasury income. A yield of 5.06, a return of capital of 3.64. It's one of the best cash alternatives that are out there. When you see a lot of ETFs out there that will invest into short-term treasury income, this is exactly what NEOS does. This is where you can park your money. It's one of the best cash parking vehicles. Now, TLTI is the long-term version of the treasury. Paying a 6% yield, it's strong when interest rates fall, which is why we keep hoping that we're going to see a December rate cut. It's more volatile in rising rate environments, and the long duration treasury ETFs with a yield overlay. It's a unique product with interest rate upside potential. Now we show you in the yield comparison between the 4 different funds. And basically the strategy, as I've told you, the HYBI offers the highest yield, but with the most elevated ROC. And the CSHI has the largest assets under management at 723 million. And then TLTI is the newest fund that came out in 2024. Now let's take a look at the yield comparison across the asset class. This chart gives you and brings you everything basically together. The crypto yields is the highest, but also the highest risk. The small caps is the next highest with the IWMI. Large caps, strong balance and risk rewarding. And that brings you into that QQQI category. And it also gets you into SPYI. The big message is important. The higher yield usually means higher volatility, more return of capital, and more movement in the NAV. So it's all about choosing the right mix for your tolerances. So you can see here, they all generate a nice income in our higher level. And each one has a particular reason to use. That's why we always say you need to contact a professional before just making a choice in the decision. Most brokerage firms have a free service that you can talk to them about and talk to them what your strategies are. So you got to consider your risk tolerances and income needs. You have to understand, not everything goes into crypto. Don't always put everything into the biggest fund. Diversification is the magic thing. Diversify in the top 5. Save a little for security. So you can build yourself a nice mix between this. Now we take a look at the assets under management analysis and the fund maturity. You look at our two big guns at QQQI and SPYI. I told you earlier that they were basically brother and sister matching strategies. One's using NASDAQ, one's using the S&P 500, and they're both in that $6 billion asset under management area. Now, why does this matter? Well, assets under management gives them the funds to invest. It gives you and tells you there's a lot of people who have money invested in this. Gives them some credibility. Look at everything else, how bad the rocketing is. We rolled everything into billions just to kind of give you the idea of how those two big powers do against the rest of the markets. We put everything into billions, and it just shows you how they just rocket. And the nice thing about it is those two have been there for just basically 1 to 2 years since launch. Now, BTCI is quickly attracting, which is the third place one at 807 million. Easily, that one should be able to attain $1 billion in just the next 6 months. Now, QQQI demonstrates the established strategies launched in 2019, maintaining strong investor interest. Now, return of capital impact. This is very critical. And I want you to make sure you understand exactly what this is telling you. Return of capital occurs when a portion of the fund's distribution represents a return of investors' principal rather than actual income generated. High ROC impact. High ROC percentages is greater than 3%. And that may lead to what everyone talks about as NAV erosion over time, potentially compromising long-term sustainability. Low ROC advantage is funds that have minimal ROC, 0 to 1%, delivering more sustainable true income without significantly eroding the principal. When you take a look at QQQI at 0.02% and QQQH at 0, have virtually no ROC, indicating high quality incomes. And when you turn around the HYBI at 5.91, this is the highest ROC, and it's definitely suggesting potential long-term NAV concerns. So you're putting a little more risk out there. So the way I always put this is you need to understand ROC. Some people use it for tax advantages. Some people use it the way it was originally designed as return of capital across the board. NEOS does a great job of balancing act across their funds. Now the risk and return profiles by strategy type. NEOS funds fall into basically 3 brackets. There's the conservative bracket, and that's going to be your CSHI, BNDI, and the TLTI. They're stable income with low volatility. These are your treasury-based strategies, with the lowest volatility and that potential stable income. The moderate is the equity and income strategies with balanced risk return profiles. Your SPYI, QQQI, IYRI, and the IAUI, all of them in double-digit yields. Now the aggressive ones, these are strategies with higher volatility for enhanced income potential. That's going to put you into the Bitcoin. It's going to put you into IWMI, and it's going to put you into NIHI. Now, knowing your risk category makes fund selection much easier. If you're extremely conservative, go with the blues. If you're moderate, go with the greens. And if you're aggressive, go with the yellows. Expense ratios. Now, treasury funds are always going to be if you want to call it the cheapest, they'll be the lowest range. And that's your 1 to 3 month T-bills with a very low rate of 0.38%. Now your next one is going to fall into the crypto markets. We're going to be the most expensive ones at 0.98%. Now equity income funds sit right in the middle. So the higher expenses are not automatically bad, specifically if volatility justifies the higher premium capture. Now, I know a lot of people talk about the expense ratios because you can look at it and you can understand it. 0.98 is much higher than 0.38, so it must mean the lower one is better. Well, for them to do the work and what they have to do with a Bitcoin versus a T-bill, there's a lot more work, which there's a lot more expense. But what this basically says to you off of, every $100 that you invest, this is how much is going to the company, going to NEOS to operate and manage it. So let's break it down now into target investor profiles. Who does what? Where do we put them? Well, if you're a conservative retiree seeking stable monthly income with minimal risk, you prefer principal preservation and the potential of consistent distributions, 4 funds come to mind that are very well suited for you, and that's the CSHI, the BNDI, and then the hedge funds, SPYH and QQQH. For the income-focused investors wanting enhanced yields with moderate risk and seeking diversification across asset classes. The funds that are suitable for you are going to be HYBI, QQQI, SPYI, and NIHI. The growth-focused investors. This is going to be primarily for focus on capital appreciation, willing to accept higher volatility. And those funds, you can see, QQQI falls into that category. So it can fall in multiple categories. IWMI and BTCI, the Bitcoin, they're all in that growth-focused area. Risk-managed growth. You wanting growth with downside protection and seeking the potential of consistent monthly income? Here's the funds. It's the hedge funds and then the IYRI. Now, if you're looking for aggressive income seekers, premium focused on maximizing your yields, you're going to have high risk tolerance for enhanced returns. There's 3 funds for you. And the alternative asset investors seeking something different than stocks and bonds, looking for different pieces, that's where we're going to get into our gold and our real estate packages. And of course, Bitcoin. Now, portfolio construction. I didn't break down exactly how to go into every single category. I've given some simple suggestions and how I would set things up personally. It's just my own personal input, nothing at all, again, set in stone or how a professional would do it, just an idea that I use. Here are some simple model portfolios. For the conservative, you got a 60-20-10-10 program. Balanced is almost across the board, a 30, a 20, a 20, 15, 15, using the SPYI, the QQQI, and a little bit of Bitcoin. And then if someone's looking for growth, we're heavily into QQQI. We're getting 30% into the IWMI. We're getting 20% into Bitcoin and 10% into NIHI. These are examples and not recommendations. And always consult a professional when you're going to get into this, building your own portfolio. The key mix of asset class is the answer to controlling your risk. Now, we talk about market environmental considerations. Option income ETFs behave differently depending on the volatility, interest rates, and the market direction. High volatility equals bigger premiums. Low volatility, lower income. Falling rates, TLTI, strength. And sideways markets, that's your hedge funds. That's giving you the stability. Each environment favors a different fund. This is why diversification means everything. So I lay out a little bit more for you here, a fund selection framework. Where are you at? If you're into conservative, if you're into moderate, if you're into aggressive, you can put your funds into different areas. You can select different categories of what you're looking to do. It's just, again, it's the match the fund with your investor profile. This is just an example. This is just throwing things against the wall to see what, honestly, how I would do it my personal self. It gives you something to work from. So implementation and monitoring, let me just do this. I want you to focus on some good habits. Start with a reasonable allocation size. You don't have to go 100% in. You can start with 5 to 15% allocation to option overlay income funds based on the income needs and your risk tolerances. Diversify income streams. Mix the equities. You got the crypto, the real estate, the bonds, the high yields, the safety stuff. Ladder your strategies to smooth monthly cash flow. That's ultimately the goal here. Monitor your yields and ROC. Watch your ROC trends. Watch your yield trends. Watch your assets under management. Is it growing? Is it not growing? Understand the quick little things to look at. and then rebalance annually. This is where I tell you, talk to your financial advisor about rebalancing. You may end up being too strong in one and need to adjust in another. These strategies are not guaranteed, but they can help you create a smoother, long-term potential income. This pretty much wraps up our full review of the NEOS High-Income ETF family. Now, if you enjoy these deep dives, make sure you hit that subscribe button, hit that bell notification. I'd love to hear what you guys have to say about this. Is it work for you? Do you like NEOS? Do you not like NEOS? Let us know in the comments below.